Let me begin by thanking Jim and the organizers of the conference for allowing me to moderate this terrific session and these two very exciting papers. So I'm going to talk about these two very interesting papers. Let me start with some context. And the context, of course, is a pandemic that was a precipitous exogenous shock with significant macro effects on firms and their employees. It has been described in the literature as the most unanticipated, large, widespread exogenous shock of all time. And it's been associated with significant policy response. Chairman Powell stated, for instance, on February 28th last year that the Fed will act as appropriate to calm markets, much as Mario Draghi did 10 years ago in announcing the OMT in response to the sovereign debt crisis. And in addition to that, there's big policy initiatives and some specifically targeted to small and mid-sized firms and their employees, including prominently the PPP. The PPP, it has been noted in the literature, was much larger than the TARP, had many times more participants in the TARP, and was a much greater financial stimulus than the TARP. In addition to that, up to date, over 100 papers, it has been pointed out by Alan Berger and Roman Raluca, have been written about TARP. We are in the first phase of papers now being written about the PPP, but it would not be surprising if we see a similar number ultimately. And so we're looking at early papers, and that's very exciting. Also, in terms of the context, we can think of a variety of metrics. Here, U.S. employment provides a good one, and you can see the precipitous drop in employment. This also frames this discussion in the session in that the first case hit the U.S. on January 21st. About 2 months later came the CARES Act with the PPP. A month later, a PPP extension. And then actually a reopened PPP at the beginning of this year. One of the papers that I'll talk about a little bit later looked at day-by-day deployment of the PPP in the first rounds, and that sort of shows how rapidly that occurred. Another way to think about what we know from the prior literature, there have been some papers already published as well as in working paper phase about the PPP, is to what extent did the PPP and the PPP-LF contribute to the relatively rapid improvement in the economy? And another way to think about it, did the PPP and the PPP-LF help firms' survival? And what I've done in this particular graph is to just plot over 2020 corporate bankruptcies, Chapter 7 plus Chapter 11. And interestingly enough, they did not trend upward. Now, getting more granular about the literature, what do we know from the papers written to date? Well, if we think about the papers that focused on the firms, we know that PPP improved firm access to finance. We know there was a positive effect on medium-term firm survival, although that may be limited mostly to micro businesses. A lot of papers have examined employees and employment, most finding positive effects, although not necessarily large. Relatively fewer papers have focused on the banks themselves and their behavior, but there are some. And so findings there, without PPP, bank loan performance would likely have been worse. Banks emphasized relationship lendings in underwriting PPP underwriting. PPP mitigated effects of a bank supply shock and seemed to benefit mostly needy firms, exactly the firms that were targeted. Also, PPP and PPP-LF had significant positive effects on small business lending. The papers here in this session also add to this subset of the literature on bank behavior. So let's turn to the papers themselves, and I'll make some brief comments about each and then a couple of comments that apply, I think, to both. Turning first to the Marsh and Sharma paper, this paper focused on community banks, defined as most of us do as banks under $10 billion, and whether the PPP program was used to reduce capital at risk. basically pitting risk aversion versus profitability. There were two approaches in the paper, and the main analysis was a Bayesian model setup. A more traditional two-stage least square setup appears now in the appendix. Key findings, and I'm just going to repeat basically what we heard, that banks that are larger, more profitable, and with higher drawdown risk, more likely to participate in the PPP. The intensity of participation was driven by risk aversion, not a drive for profitability. And the PPP offset potentially a large contraction in business. I see the key contributions here. First, methodology. The joint estimation in the Bayesian setup to control for selection effects and simultaneity of decision-making in a joint model that solves simultaneously for participation intensity, and bank outcomes, I think in and of itself is a key contribution to this literature. The focus on community banking is important, particularly making distinctions among community banks, and the finding that lenders are driven by risk aversion funding and funding capacity and not profitability is certainly an important addition to the literature. Brief comments. I would like to see more distinction in this paper from the Lee and Strawn paper. And specifically, what do the results here say about the importance of relationship lending? And I say that because this paper notes that the results are in line with Lee and Strawn, but there's relatively little discussion of how and to what extent, at least in the main Bayesian analysis. That is, for example, a discussion of unused commitments as a measure of liquidity risk, not as relationship lending. So the key unanswered question that I had coming away from the main analysis is, well, what is the relative importance of risk aversion versus an emphasis on relationship lending in driving PPP underwriting? But I will say that to some extent, this is addressed in the secondary tests that now appear fairly late in the paper on page 78 using the alternative approach. And I would argue that they depend to a certain extent on interpretation and the strength of the other relationship variables in that analysis. And those variables don't take into account with what I think of as the real strength of Lee and Strawn's paper, which is their periphery test. So I would like to see more discussion of that in the paper. Now, I would also mention that Lee and Strawn also run separate tests on community banks, and I would just note the results are not the same, at least on some dimensions, and that's probably worth a comment in the paper. Turning to the second paper, the focus here was on the PPPLF, as we learned, and was it successful in bolstering the PPP? Again, a focus on community banking, large versus small community banks, a two-stage least square methodology with a very interesting IV for the PPLF, and that is familiar with the discount window. Key findings, banks using PPLF made twice as many loans per dollar of asset. The discount window experience increased PPPLF use, using particularly a strong effect for smaller banks, which is interesting. Banks with more unused C&I commitments use more PPPLF. There's evidence for the backstop. PPLF was causally linked in their back of the envelope analysis to $53 billion more in PPA bank loans, and smaller banks drive the results. So these were the main findings. I would say that the key contributions here is the extending the literature by examining whether PPPLF was causally linked to PP lending, which has not been done in the literature before. I think this instrument is a very interesting methodological contribution and new to the literature. And again, I think, and of course, completely relevant to this conference, the differences between smaller and larger community banks are of great interest. Brief comments. I would like more discussion of the significance of unused commitments. Does this reflect relationship lending or does it reflect liquidity? And I would argue actually that it's an imperfect proxy for both. Unused commitments is an imperfect proxy for relationship lending, and I would use as an example asset-based lending centered on lines of credit is a transaction-based loan, not a relationship loan. And then turning to, for instance, as a proxy for liquidity, it's also imperfect. And I would again use asset-based lending and its junior cousin, borrowing-based lending, as a good example, because excess availability against eligible accounts receivable and inventory, not the unused portion of the commitment, represents liquidity exposure. Another interesting result of the paper is small business lending was negative in predicting PPPLF, and I would like to see more clarification on that in interpreting it. I would like to see some distinction or more distinction between this paper and Lopez and Spiegel that also look at PPPLF using an IV approach. And you note in the paper that your paper is highly complementary with theirs and not a substitute. And I would just like maybe in the conclusion to flesh that out a little bit, because I think I was looking forward to more of an explanation. And I would also note that the first paper also models PPPLF participation. And again, you might want to talk about some of the differences here from that paper. Final comments that apply essentially to both of these papers. There is an emerging literature on partisan politics and bank lending. And my colleague here, Janet Gao, has put a marker in the ground on that. But there are now 2 papers specifically focusing on PPP. And I think when we think about what's driving both participation and intensity, this is something we might want to add. I was very interested in a comment early in the Marsh and Shama paper about the essentially using the Japan Special Credit Guarantee Program as another type of crisis guarantee program. This was a very big program, and there's actually been a lot written about it. You might follow up on that. I was looking for a little bit more in the conclusion, and also looking to future research. This may be the closest benchmark we have when we look across the globe. So let me conclude. I've run out of time. I saw that time clock there, so I know I'm in trouble. I will conclude by saying these 2 papers are a must read for anybody doing research on this topic, and a must cite. So I very much enjoyed reading both.